posted March 29, 2018, 13 hours 4 minutes and 35 seconds. If you want a conversation stopper at a party, talking about corporate taxation will likely do the trick. But despite its eye-glazing potential, the amount of money Australian companies pay in tax remains a hot topic in federal parliament. Nearly 3 decades ago, Kerry Packer famously trashed the idea of anyone paying more tax than was absolutely necessary, making headlines around the world. The late media mogul famously told a Senate hearing in 1991 any Australian who didn't minimise their tax needed their head examined. "There's nothing wrong with minimising your tax," Mr. Packer told the senators. "I don't know anybody who doesn't minimise their tax. As a government, I can tell you you're not spending it that well, that we should be donating extra." The coalition shares the view businesses can make better use of some of the corporate tax they're paying than the government, arguing a tax cut will boost investment and therefore jobs and wages. The Turnbull government wants to reduce the amount big companies pay in tax by cutting the corporate income tax rate from 30% to 25% for all companies by 2026-27. The bill is currently stalled in the Senate, a couple of votes short of the support it needs to pass. The key questions for those senators are, can Australia afford a company tax cut now? And if taxes aren't cut, will the nation's businesses remain competitive? Can the budget afford a $65 billion revenue hit? One problem with any tax cuts at the moment is that the federal budget remains in what's called structural deficit, meaning the government isn't collecting enough revenue to pay for the services it's currently providing. Even when the economy's doing okay, it's basically a matter of cost. Deloitte Access partner Nikki Hutley said, "We're talking $65 billion to the budget bottom line at a time when we're trying to get the budget back into surplus. We've certainly moved closer to that surplus in the last year because the economy and employment have been better than expected, and commodities have held up, but if we were to do anything in one big hit, this would set the government back on its promise to get us to surplus by 2021. Some small businesses are already getting a tax break. From next financial year, businesses with a turnover of less than $50 million get a 2.5% tax break to 27.5%. It's a policy designed to help small and medium-sized business owners bring on more staff. Labor says it's likely to keep that policy if it wins government, so that one seems to be a bipartisan winner. It's a relatively small cut, but for a large sector of small businesses, Ms. Hutley explained, if you believe the government's rhetoric, the investment numbers we've seen have in fact improved in the last 6 months. Certainly, you might attribute it to that, but there are normally quite long lead times with investments, so for meaningful investments it's hard to yet. There's not a solid evidence base to suggest that they've yet had an impact. You would expect that, over time, there certainly would be some impact. Is Australia being left behind corporate tax rates elsewhere? So the jury's out on the impact of small business tax cuts, but what about for the big end of town? The Federal Treasury estimates the big business tax cuts have the potential to add $20 billion a year to the economy once they take full effect in about a decade. But that assumes Australia's company tax rate remains internationally competitive. So, is it? Independent economist Sol Eslake says sort of. Australia's tax rate will still be higher than some other countries, including now the United States and the UK, which have corporate tax rates of around 21%, he told RN Breakfast. Certainly countries like Ireland, Hong Kong, and Singapore, which have very low corporate tax rates. According to the most recent OECD data from 2017, Belgium, France, Germany and the United States were the only developed countries that had higher headline tax rates than Australia, while Japan, Mexico and Portugal were about the same, around 30%. Since then, the United States and Japan have both moved to cut company taxes. Deloitte economist Nikki Hutley agrees even if Australia's company tax rate is cut to 25%, it'll still be in the middle of the pack. You know, it's not a one-size-fits-all answer, she told RN Breakfast. It certainly will make us more competitive against some markets, but not all of. There are large compulsory social security contributions businesses have to make in some countries, but not here, while Australian companies must pay state payroll taxes, none of which are included in the OECD corporate tax numbers. Few firms pay the headline tax rate, but the picture becomes more complicated still when you consider various tax deductions, which differ significantly across nations. Because, even with a corporate tax rate of 25%, how many companies actually end up paying that level of tax? Not many apparently. For example, two companies on the same headline tax rate may end up paying different effective tax rates if one company can reduce its taxable income by claiming various deductions for research and development, interest costs, depreciation, and so on. As Nikki Hutley explains, most corporations don't pay the headline rate of tax, even on their net profits. They have legitimate expenditure deductions, and that might be prior year losses or investments, she said, so the effective rate is always going to be lower than the targeted rate, and that's absolutely fair and